I'll be discussing three business models. Due to time constraints, we won't be delving deep into the numbers required to assess the quality of a business or its valuation. These case studies hold personal significance. My family members and I own shares in some of these companies that I will talk to you about today. My clients also own shares in these companies. So please keep that in mind when I talk about these cases with you. I'm not recommending these talks to you. I'm only using them as illustrations to talk about key ideas that I've learned as a practicing value investor over the last 30 years. So the best investment I ever made was in London in 1993. While studying at the LSE, I signed up for a course called Security Investment Analysis. That was a standard course that taught me that the markets are efficient and there are no mispriced bets. The idea that a stock's value could differ from its price was not acknowledged. Even today, that's a standard economics textbook definition of an efficient market. But while studying all this, I came across an article in the Financial Times about this obscure investor. I'm talking about early 1990. And this obscure investor operated out of Omaha and had an excellent track record. And he explained how he invests in things about business and investing. And of course, I'm talking about Warren Buffett over here. And I also read that I could get these letters that Mr. Buffett wrote by writing to his office. They asked me to send money for postage, which I did. That's the best investment I ever made because I went on to learn more about the world of business and investing and life by reading these letters. As I read through them, I underlined almost every page and found my calling to be a value investor. As a trained accountant, I knew how to study financial statements, but I had no clue about what's a good business, what's a bad business, what's a mediocre business, and why. Reading those letters gave me insights into business economics and psychology, which became a favorite discipline for me. Buffett is one of those excellent investors who combined psychological principles with economic principles and could explain complex ideas in a manner that was very easy for me to understand as a trained accountant. I knew how to study financial statements, but I had no clue about what's a good business or what is a bad business. I could now connect the dots through his letters. I discovered his own teacher, Benjamin Graham, through those letters, and I went out and bought all his books. I bought all the editions of Security Analysis and all the editions of The Intelligent Investor, and I worked through the examples that were provided in both these books. As I worked through those examples, I could relate to what was happening in India. India in 1990s was opening up, and there was a lot of restructuring in the economy that was going on. And therefore, I decided to return to India. And I did that in 1994 and started my investment practice as a value investor. I have just completed about 30 years as a value investor. LSE was instrumental in this journey for me. I was in London because of the LSE, and my presence in London gave me a chance to discover Warren Buffett, learn about him, and then come back to India and find my boutique firm. I'm going to talk about 4 big lessons. Of course, there are many other lessons that I picked up over the years, but I'm going to focus on 4 key lessons that I want to use while presenting these cases to you. The first one is that investment opportunity is the difference between perception and reality. Perception is how markets view a business. Reality is what the underlying fundamentals tell you. These two things could be very different. And when they are different, there could be an opportunity. That's the first lesson. The second lesson is that a value investor learns fairly quickly that pessimism breeds opportunity. Pessimism is a friend. And that's what I found out. And over the years, I discovered that I love pessimism. Not because I'm a pessimistic person, I'm not, but because I like the prices pessimism produces. There are 2 types of pessimism. There is warranted pessimism, which means that the price is correct. And then there is unwarranted pessimism, which means the price is not correct. And therein lies the opportunity. The third big lesson that I want to draw upon is that you're neither right nor wrong because there are other people who agree with you or who disagree with you. You're right because of facts, reasoning, and logic. And the last and the fourth big lesson is that in the short term, the market is a voting machine, but in the long run, it's a weighing machine. That's, of course, a quote that will be familiar to many of you from Benjamin Graham. Basically, what it means is that in the long run, fundamentals matter. In the short term, of course, emotions like greed, fear, loss aversion, and other psychological tendencies play out. So let's start now. Let me focus on some of the quantitative markers of quality. There are some 5 or 6 of them. You're looking for high returns on capital, which means that the business has to be successful in terms of how much money it earns as a percentage of capital employed. And high returns on capital make sense only if you have entry barriers, because if the returns on capital are high momentarily, but the entry barriers are low, it's only a matter of time when competition will come in and destroy the excess profits that the business is earning. So the excess returns will eventually get eroded. So you need strong entry barriers. The third one is that you need reinvestment opportunities, which means you can need to be able to put the money back in the business that it is earning so that it can grow its earnings. And that's a very critical component of value investing in growth businesses. Because what that means is that there are a whole bunch of businesses that can earn extraordinary returns on capital, but don't have the ability to grow that business because there are no reinvestment opportunities out there. And if that's the case, that's not interesting to many value investors, including to me. So I'm looking for growth companies, but at very cheap valuations. The fourth component is a predictable and stable earning stream. These businesses serve a predictable need and the risk of disruption is negligible. The earning streams that are coming out are going to be very stable and predictable, and that will enable us to value these businesses. The fifth component is robustness. And one of the single most important sources of a robust business model is a strong balance sheet. By that, I don't mean that you should have no leverage in the balance sheet. We do invest in levered financial institutions such as banks, for example, or non-banking financial companies. But we only want to invest in the ones which are having the strongest balance sheets in the industry. So a strong balance sheet is crucial because it allows the business to survive recessions, downturns, and economic tsunamis that keep occurring. And the last component, which is very important, is the ability to self-fund growth. Because a business generates so much cash that it does not need outside capital markets, no new shares will be required to be issued. And there will be negligible need to raise any borrowed money except in financial institutions. And even if borrowed money is used in non-financial institutions to fund, for example, a growth program, then it's only a matter of time when that debt will be paid down, usually within the next 3 or 4 years. Many years ago, I came across a letter written by Benjamin Franklin, who is one of my role models. That letter was written back in 1772, but I think it's still relevant for all of us. Reminds me of the Lindy effect. So what's so special about this letter? For one, it demonstrates Ben Franklin's amazing psychological astuteness. Long before concepts like availability bias, first conclusion bias, confirmation bias were named, he had already figured out their essence. Let me read from this letter that he wrote to one Joseph Priestley. Franklin titled that letter Moral or Prudential Algebra. And this is what he wrote on 19th of September 1772. These difficult cases occur chiefly because while we have them under consideration, all the reasons pro and con are not present to the mind at the same time. But sometimes one set present themselves and at other times another, the first being out of sight. To get over this, my way is to divide half a sheet of paper by a line into 2 columns, writing over one pro and over the other con. Then during 3 or 4 days of consideration, I put down under the different heads short hints of the different motives that at different times occur to me for or against the measure. When I have thus got them all together in one view, I endeavor to estimate their respective weights, and where I find one on each side that seem equal, I strike them both out. If I find a reason pro equal to some 2 reasons con, I strike out the 3. If I judge 2 reasons con equal to some 3 reasons pro, I strike out the 5. And thus proceeding, I find at length where the balance lies. Why do I love this letter? I love it because it effectively deals with those biases that I mentioned just now. Benjamin Franklin offered us a framework to use which not only forces us to consider pros and cons about a matter, but also makes us trade them off each other to arrive at a balance, and that too after much reflection on that matter. That framework is prudential algebra. So back in 2020, when I was writing a note on PSUs, I followed the procedure laid down by Ben Franklin. I was looking at the PSU space for a long time, and I could see that the space was being treated as untouchable by a very large percentage of investors out there. I was very intrigued by this because the numbers were saying something else, but the perception in the market was completely different from what I felt was the underlying reality. So I could see that there were many stocks which had all the markers of quality, but these businesses were deeply out of favor in the stock market and were selling at multi-decade low valuations. And I felt that in some cases the prejudices were quite unwarranted, which means there might be an opportunity here. For those of you who are not from India, PSU means Public Sector Undertaking, that is government-owned companies, or companies in which the government owns the majority shares. Typically, bureaucrats run these companies, and these bureaucrats are not going to be around forever. They are there for a few years and then they will go. There is this perception that these companies are mismanaged, and to a large degree, that perception is correct. But is it right to throw out the baby with the bathwater, or to paint everything with the same brush? Of course not. But I felt that was the case here, and therefore there was this opportunity. I looked at a very interesting case at the time which had come up, which is this company called the Indian Railway Catering and Tourism Corporation, or IRCTC. This company has a monopoly business. It's the only company which is allowed to issue railway tickets. It is also the only company which provides catering services to Indian Railways. This is a platform business which had gone public just a few years ago. And I was astonished to see that this company's stock was selling at a valuation which you would not find anywhere else in the PSU space. So I had a hunch that a change in perception about PSUs may have started happening. A lot of investment opportunity is about noticing change. There is a perception which is bad, and there's a reality which is very different, and then the perception starts changing. So I saw that there may be something going on. Maybe investors are becoming quite discriminating and they're willing to buy the really high quality business models in the PSU space like IRCTC. I noticed that this company went public at $64 per share, adjusted for a stock split subsequently. And when I wrote that note in 2020, it was selling at $251. By the way, right now that stock sells for $929. So we are looking at some extraordinary wealth creation that had happened till then, and even subsequently, despite it being a PSU. And I felt that perhaps this could become a pattern. Maybe there are other PSU companies having similar markers of quality that IRCTC has, and that will over time will also be re-rated by the market. They will be treated much more fairly than what the perception about the PSUs was suggesting until now. So I laid out what was wrong with the PSUs. Many of the PSUs clearly have very inferior business models. They are commodity businesses. They don't have any pricing power. And many of them have excessive leverage, like in public sector banks. So that was a big no-no for me, and for many reasons. One of which was that there is a lot of government interference in these businesses, and often the politicians' interest does not align with the interests of the minority shareholders. One thing that I've learned is that people are self-interested and politicians are no different. They want to get elected and re-elected, and they will often do things that will gain popularity for them but could ultimately destroy value for minority shareholders. And that has happened in India a lot over the last 50, 60 years. And people remember that. But my hypothesis was that the taint of what had not worked very well for minority shareholders in many PSUs was being applied to all PSUs. So I decided to be a bit more discriminating and isolate cases where there is no need for this unwarranted pessimism. And the fourth point was the people who run these companies don't own the stock and they're not going to stay around because they are bureaucrats. They don't have a skin in the game. They don't have the right incentives and so on. But at a higher level, I found that the same problems also occur in private space and not just in the government-owned companies. This problem also exists in companies which are not controlled by the government, but are controlled by families, for example, or by multinational companies. Many of these non-government owned businesses also have inferior business models or have excessive leverage or have interference by the families who control them or even by the multinational parent companies which have listed subsidiaries in India where the minority shareholders' rights are not always respected. And there are many examples where minority shareholders' value has been destroyed even in non-government owned companies. So why single out government owned companies and treat all of them as untouchables? I felt that at the end of the day, whether you look at PSUs or you look at companies not controlled by the government, the apprehension about the behavior of controlling stockholders in both spaces should be treated identically. Because in each case, we are looking at the controlling stockholder risk at the end of the day. So you can't say that I will not buy PSUs no matter what the price is, no matter what the quality of the business is, no matter what the quality of the balance sheet is, no matter the fact that the government has hardly interfered, but in fact, the government has facilitated the growth of this business. Many of these businesses are monopoly businesses. But there was this strong belief amongst a vast majority of the people in the investment community that PSU space was untouchable. And investors felt that no matter how good the business is, no matter how cheap the valuation is, I'm not going to buy into that. And that I found intriguing, that there was this massive bias against PSUs. And I thought there was an opportunity for my clients. After listing the cons, I followed the procedure recommended by Ben Franklin and started listing the pros of investing in PSUs. So one of the big pros was that some of these PSUs have a very business model and that they may also be less susceptible to government interference. In the examples that I will cite, I will talk about this. And a big part of the whole discussion about pros was to do with valuation. And here, as a trained value investor, I found that their stocks are quoting at insanely low multiples of earnings and book value and are offering very high dividend yields. And this was despite the presence of the markers of quality that I talked about earlier. The only reason they were selling at such a low price was because they were controlled by the government, and for a vast majority of investors, they were therefore untouchables. And if something becomes untouchable, then there's a good chance that it might become massively undervalued. And I thought that this might be happening in the PSU space at the time. Let me start with the three cases that I'm going to present to you today. The first case is on a Cochin Shipyard, about which I wrote in April 2020, just around the time COVID hit India. Cochin Shipyard is India's largest shipbuilding and repair company, and it has an impressive track record of delivering different kinds of vessels, both to the government and to private customers. The only shipyard in India that can repair an air defense ship and has undertaken complex repairs on aircraft carriers for the Indian Navy. It is essentially a defense play. Of course, today we have funds that are being created for investing only in defense companies. But the wonderful thing about CSL is that the largest customer of this company is the Indian Navy. And that has a lot of ramifications for the quality of the business model, as I will explain. Apart from the Navy, Cochin Shipyard also supplies vessels to the Indian Coast Guard. And this means that the business is not cyclical. Cochin Shipyard is not like a typical shipbuilding company because it caters to the defense requirement of India. And back in 2020, the company was making India's first aircraft carrier, which was subsequently delivered. And now there is talk of a second aircraft carrier. The aircraft carrier order was a very prestigious order for Cochin Shipyard. And after its execution, it put India into the elite club of just 5 countries which have the capability of building their own aircraft carriers. And it was a very big project for them. Cochin Shipyard has a very strong order book going into several years. The company for a long time was earning a pre-tax return on equity of between 23 and 26%, which is substantially more than what you can get in high-grade corporate bonds. In fact, more than 3x of what you can get in corporate bonds. It's a debt-free company, and in fact, it had excess cash. And the reason why it had excess cash was that the Indian Navy and the Coast Guard were paying this company in advance. So the company had float, which is a very favorable component of a superior business model. It didn't have any receivables. Instead, it had money from customers given to it upfront. This meant that the shareholders did not have to put up at the money or borrow any money to fund the business, which was essentially funded by the customers. And that's a very favorable trait to have, something that I will make a reference to multiple times in this presentation. The float ensured that the company did not have to fund the business through its shareholders, and therefore the return on capital employed became extraordinary because the denominator in the ratio became quite low. The business of Cochin Shipyard is very capital efficient, even though it is a capital intensive business. Making ships is very capital intensive. But the important thing here is that the capital intensity of the business does not necessarily equate with capital intensity for the stockholders because the money is coming from the customers. The company also had superb profit margins going back more than a decade. And if you looked at the cyclicity of the shipping industry versus the cyclicity of this company's margins, there was no cyclicity here for obvious reasons. And if you looked at the cyclicity of the shipping industry versus the cyclicity of this company's margins, you would find that there was no cyclicity here for obvious reasons. And it had grown and grown over the years. After Mr. Modi became the Prime Minister of India in his first term in 2014, up until 2019, he increased India's defense expenditure. In the second term, he increased it even more, and the aircraft carrier was also delivered by Cochin Shipyard to the Indian Navy. And as India's nationalistic Prime Minister, he wants India's defense capabilities to be one of the best in the world. Obviously, this is wonderful news for a company like Cochin Shipyard. So Cochin Shipyard is a play on the expansion of India's defense capabilities, including naval capabilities. And it was in the right place at the right time. Of course, there are a few other companies which also are in that space, and their stocks have also gone up quite a bit in the last few years. But at the time when I was writing all this in 2020, none of these things had happened in the defense sector, in the stock market. And Cochin Shipyard was selling at a ridiculous valuation, even though it had all the quantitative markers that you will look for in a high quality business. Over the years, Cochin Shipyard has become more diversified. One way that's happened is through its ship repair business vertical. The repair business has higher margins, lower capital intensity, and is also growing rapidly. Indeed, even the US Navy signed up as a customer recently. This is not a small development, and it has everything to do with Cochin Shipyard being a PSU, something I will refer to later. Over the last decade or so, many shipbuilding companies in the private sector have gone bust. So the competitive pressure in the industry has gone down, which is always a favorable factor in business analysis. Another advantage enjoyed by Cochin Shipyard is that the Indian Navy and the Indian Coast Guard prefer to do business with the company. One big reason, of course, is security. After all, the designs of an aircraft carrier are top secret, and the Navy would not want to hand them over to a commercial organization it cannot trust. And Cochin Shipyard can be trusted as it is controlled by the government. One very favorable factor about Cochin Shipyard is that its contracts protects margins. Essentially, this company's contracts are cost plus, which means that inflation in raw material cost, time overrun, cost overrun, changes in specifications requiring more money to be spent on the construction of the ship, all these costs are borne by the customers. And that is obviously a very favorable factor because that means the company is completely immune from input price inflation or cost escalations. Another unique advantage that Cochin Shipyard has is that it has a low cost advantage given that shipmaking is a labor intensive industry So obviously the low cost advantage is there because labor costs are low in India. But apart from that, the company also has a flexible cost structure, even in labor costs. That's because more than 60% of its employees are temporary. And that helps a lot in the event if there is a contraction in revenues, which is exactly what happened during COVID. I mentioned this earlier, but I want to say it again. Float is a very important component of the business model of Cochin Shipyard because even though the business is capital intensive, a big part of it is funded by the customers because the customers make upfront payment to Cochin Shipyard, and that reduces the capital employed in the business and boosts return ratios. One of the things that I do in my classroom is that I put the financial numbers of companies in front of students and I hide the names of the companies and show them quantitative markers of quality. The students look at mass financial statements and compute the returns on capital. They look at the growth, they look at the margins, they look at the stability of earnings during industry and economic downturns. They look at the balance sheet quality and they form a view about the quality of the business and its management. And then I ask them, what kind of a person runs this company? And almost always the answer is that the company is run by somebody who is very driven, someone who has skin in the game, and that this is like a founder driven business run by someone who is hungry and passionate. But when I reveal to the students that it's actually a company that is run by bureaucrats who are not going to be around for more than a few years, and that somebody else is going to replace that person, they are quite shocked about it. Therein lies a bias which arises out of stereotyping. We draw conclusions about a specific person based on stereotypes. In this context, the tendency is to assume that the management was incompetent because it's a PSU. I think instead of forming views based on stereotypes alone, one should let the actual performance of the business dominate the discussion. So if you do that with Cochin Shipyard, you will very quickly conclude that they run a very tight ship and the management team has delivered exceptional performance over time. One of the biggest pros that go in favor of PSUs is the extraordinarily attractive valuation metrics. Just look at the metrics of Cochin Shipyard in 2020. Price earnings ratio of 4.3 on a pre-tax basis and a starting pre-tax earnings yield of 23%, earnings growth rate of more than 20%, a debt-free company, and a starting dividend yield of 5%. It was ridiculously cheap, but not for long. As the market's perception changed, so did the valuation metrics. And the perception changed because of the growth in earnings, growth in diversity of earnings, increase in the size of the order book, increased visibility of the capabilities of the company after successful delivery of India's first locally manufactured aircraft carrier. Now let's talk about the prospect of getting an order to manufacture India's second aircraft carrier. If the Indian Navy decides to order a second aircraft carrier, then it is almost certain that the order will go to Cochin Shipyard, as it's the only company that has the capability to do this in a trustworthy and efficient manner. To put things in perspective, Cochin Shipyard has a top line of just about rupees 3,500 crores per annum at present. If the order of a second aircraft carrier comes, then it will be worth at least 40,000 crores and probably a lot higher as specifications tend to change over time and this results in cost and revenue escalation. The design is secret and you can only trust an Indian company to make that. And the only company that can make that is this company. So it's not a question of if, it's a question of when. Does India need a second aircraft carrier? I think the answer is yes. When will they make it? When will the order come? I don't have answers to these questions. So there's this element of optionality and you're not paying for that. Aircraft Carrier 1 was delivered in 2020. The order for Aircraft Carrier number 2 might be placed sometime in the next few months or years. I don't know. Maybe it will come in 5 years, 7 years. I don't know. But one is not paying for that at the valuation that I mentioned. So that was a very attractive sort of a setup that I absolutely love in these cases. You can see the stock price chart here shows that the stock did nothing for a while and then has shot up. And again, this is not an isolated case. This is just part of overall development where the prejudice against PSUs to a large degree was reduced. The markets may have actually gone to the other extreme from unwarranted pessimism to unwarranted optimism. That's true at least in some cases in the PSU space. And this company has very much participated in the re-rating across the board that has occurred in that space. The second case is even more stunning. It's a business called IRFC, Indian Railway Finance Corporation. This is a company which is a non-banking financial company and it has one customer. The customer is Indian Railways. So this is the case actually that I presented in 2023 in Flame Investment Lab, and I had students in my class who are fund managers and they would say, I'm not going to touch this business because it's a PSU. And it was funny because one of the students was running a debt fund and that student said that he would be happy to buy the bonds of this company because they're AAA, but would not touch the stock. The funny thing was that the bond was yielding less than what the stock would have yielded in the next 2 years because of the growth in earnings and dividends and the initial dividend yield. I was very much delighted to come across this business model, and what I saw totally blew my mind at the time. IRFC's core business is to finance the rolling stock acquisition by the Indian Railways. IRFC finances the acquisition of locomotives, carriages, and wagons to Indian Railways. It provides its funding to Indian Railways by borrowing money on its own balance sheet, by re-lending it effectively to Indian Railways at a small yield above its borrowing cost. The company essentially helps Indian Railways carry out its CAPEX program. So IRFC, which has been around for more than 30 or 40 years, is a company which actually borrows money from the markets and uses that money to buy the rolling stock. And then it leases that rolling stock to Indian Railways at a small markup over cost. So essentially, IRFC is an investment banker with just one client. And the amount of money that IRFC makes in terms of spread over cost is just about 40 basis points. But when you have 40 basis points being earned over tens of billions of dollars of asset book, that translates into a lot of money. The key question that comes to mind is that why does IRFC actually exist? Why Indian Railways not borrow directly from the markets? The big part of the reason to my mind is that there is a need to hide government debt. If the government of India was borrowing money on its own balance sheet for Indian Railways, then that debt would form part of India's consolidated debt. But when the government of India asks IRFC to borrow effectively on its behalf to fund the CAPEX program of Indian Railways, then the debt of IRFC does not form part of the consolidated debt of India. This is true even though the debt of IRFC is guaranteed by the government of India. So basically, IRFC acts as a conduit through which the borrowing of Indian Railways is done, and the big benefit of the government is that the debt of IRFC does not form part of consolidated debt of India. IRFC has no non-performing assets. This company is designed to never have an NPA. Why is that? Because the customer who owes it money in the form of lease rentals is sovereign, and that customer can literally print money to pay IRFC. So they can never be in default in this company. Recall that we are looking at a lending operation which is designed to never have an NPA. In lending businesses, we also worry about customer concentration risk. But here the concentration is 100%. But that's not a problem at all, simply because the customer is sovereign. The business is also immune from time and cost overruns on projects financed by IRFC. So no matter what happens to the price of steel or labor or anything for that matter, it is not IRFC's problem. It's the customer's problem who will reimburse IRFC for all cost and time overruns. All increments in IRFC's borrowing costs are also passed on. So there is no interest rate risk either. If IRFC borrows money in foreign currency and if there is a rupee depreciation and the cost in INR goes up, that escalation is also passed on to the customer. So there is no exchange rate risk as well. There is no asset liability mismatch and no possibility of one either, because of a backstop arrangement with the customer, according to which, if there was ever a possibility of a shortfall for making payment to IRFC's lenders for debt service requirements, it can draw down on a facility of the Government of India to make the payment. IRFC has never had to use that facility, but it is there in all the agreements. I was astonished to see that the company does not pay any income tax. Indeed, it is exempt from income tax. It doesn't pay any GST either. This clearly shows that this company has been created for a purpose. The purpose might be to hide debt, but that doesn't matter to me. What matters to me is the quality of the business model that has emerged and is now listed. And what am I getting versus what am I paying for it? Stunningly, IRFC has a capital adequacy ratio of 440%, which is like beyond whatever I've ever seen anywhere in the world. And the reason for this is obvious because the risk weight of lending to sovereign is 0. So that's why the capital adequacy ratio is very high. I asked a question from one of my students in the class who was a bond fund manager and asked that if we were to withdraw the entire equity as a special dividend payout and the debt equity ratio will go through the roof, would you still buy the bonds of the company? And the bond fund manager said, yes, I would do it in a heartbeat. And the reason for that is because the debt is guaranteed by the government and enjoys a AAA rating. Indeed, the debt equity ratio of this company is absolutely irrelevant. The company can borrow enormous amounts of money and still not have any threat of a credit downgrade or anything like that. If you compare the capital adequacy ratio of IRFC, that of the top banks or NBFCs in India, you will find that this company comes out way ahead. As mentioned earlier, IRFC is very profitable, even though it earns only about 35 to 40 basis points over the cost. And the big part of the reason is because there is no possibility of any non-performing asset. And the cost to income ratio is extraordinarily low simply because there are only a few employees who are running this company. And then if you consider the fact that the asset book is a few tens of billions of dollars, obviously the total aggregate profits of this company are also going to be extraordinarily large. If you look at the cost to income ratio of IRFC, you will be astonished to find that it is less than 1%. Because they only have about 30 or 40 employees and hardly any other costs. It is an investment banking operation after all. They're just borrowing money and they're lending it onwards to the government, which is their only customer. And it is extraordinarily profitable. Just like in case of Cochin Shipyard, which was a play on the growth of India's defense infrastructure, IRSC is also a play on the growth of India's railway infrastructure in a riskless manner. There are other businesses in the railway space which I have invested into and which have also done extraordinarily well, but I don't want to talk about them because essentially they conform to the same pattern, which is that if India is going to spend a lot of money on the expansion of its railway infrastructure, some companies are going to benefit from that. IRFC was clearly one important candidate in that list. As you can see, IRFC's earnings have grown hugely over the years. And the reason why that has happened is because the assets have grown. If you just think about the simple mathematics behind it, if the assets have grown, if you have a fixed spread on what you will earn over the cost of your fund, then no matter what the cost of fund is, and if there is no asset liability mismatch and there are no NPAs, then as assets grow, the earnings will grow. And that is what has happened over here. There is no credit risk. The earnings have grown and grown as assets under management have grown. Now, one of the most stunning things is to see what has happened to the earnings per share. This company did an IPO in FY21. This is the only table that I'm going to produce and I'm doing it for a reason. Notice what is happening here. In FY10, the earnings of this company were 4 billion rupees. They grew to 44 billion rupees in FY21. That's a 10x. But look at what has happened to the earnings per share. The earnings per share has actually declined over this period. What the hell is going on here? And the answer is that the share count has gone up hugely. Now what's going on here? What basically happened was that they had an internal target of 10:1 debt equity ratio, and whenever they were growing rapidly and they needed to get more equity into the business, they would just go out and issue more shares at 10 rupees per share par value to their only customer and to their only owner, which at that time was the government of India. This was prior to the IPO. And as a consequence of that, the share count growth massively outpaced the growth in earnings, and the earnings per share in FY21 is lower than the earnings per share in FY10, even though the earnings have become 10x the earnings in FY10. Just to maintain a certain debt to equity ratio, when more shares were needed to be issued to the sole shareholder, some bureaucrat in some government department decided that all those shares will be issued at 10 bucks per share, which was the par value, regardless of what the book value was and regardless of what the fair value of the stock was over those years. And it didn't really matter because before the IPO, the only stockholder was the government, so there was no risk of any dilution. And the issue price was therefore irrelevant. But the mathematical consequence of the issue price being kept at 10 bucks per share, even though the book value per share was much higher, was that the share count grew much faster than earnings. And therefore the earnings per share actually ended up going down. So this was like absolutely stunning to me to think about. And the obvious question for me was, what will happen to the companies subsequent to the IPO? Will the company continue to massively increase share count by issuing more shares at 10 bucks per share even after the IPO just to maintain a target debt to equity ratio? For all sorts of reasons, which I don't have time to get into today, the answer to me was overwhelmingly no. And if I was going to be right about this, then the next question was this: what will happen to earnings per share if earnings kept growing because assets were growing and the share count stopped growing? The mathematically obvious answer to that was that the EPS will grow massively. And that is exactly how it turned out. I don't have the time to go into those details, but I had a very strong conviction, backed again by management commentary, that there will be no new shares that will be issued subsequent to the IPO. Now think about this for a moment. You look at the growth of this company in terms of total earnings growth over the years, and you also know that the assets and the management are going to keep growing because India is modernizing its railways. Just imagine what will happen to the earnings per share if the earnings kept growing but the share count stopped growing. Obviously, the earnings per share will grow, and that is exactly how it's turned out to be. As you can see in the bottom part of the slide, there has been a massive re-rating of the stock in the recent past. The point is to see what has happened to the company post the IPO. Nothing happened to the stock from IPO till FY23, and then it shot up. The reason is that post IPO, issuances of shares stopped, but the earnings growth continued. And as a consequence of that, EPS grew massively. And because the EPS grew massively, the stock price also grew massively. It's a very simple calculation. If the price had not gone up, and if you're buying it initially at a very cheap valuation, then what looked like a cheap thing will become incredibly cheap as earnings kept growing. If you buy something at 4 or 5 times earnings, and the earnings are growing at 25% per annum, and the stock price does not grow, then what is cheap will become ridiculously cheap in a while. If you look at the quality of this business model that I described, it was absolutely fantastic. The only concern here was that the company is controlled by the government and therefore regarded as untouchable by a large number of investors. And I love that. If something becomes untouchable, I am naturally attracted to it. And I'll come to this point toward the end of my discussion with you today, because what was untouchable 4 years ago is irresistible today, and maybe there are other parts of the market which are untouchable today might become irresistible a few years down the road. My last example is again a government-owned company called MSTC. It's a boring name, but the business model is not boring at all. Actually, it's a very sexy business model. MSTC is responsible for conducting electronic auctions called e-auctions, primarily on behalf of the Government of India and related parties like government-owned companies. The Government of India has another entity called GEM, which is called Government E-Marketplace, which it uses for procurement. For sales, however, the government relies to a very large extent on MSTC, and there is no significant overlap between these two entities. For example, in 2022, Government of India auctioned 5G telecom spectrum with the help of MSTC. This very complex auction, which went to 40 rounds, was conducted in a fair and transparent manner and generated more than $18 billion for the government. The two key characteristics of auctions, fairness and transparency, are essential not only for attracting genuine buyers and sellers to a marketplace, but also to help the government in another way. The government does not wish to be perceived as favoring any individual buyer while selling off all sorts of natural resources. Indeed, numerous judgments issued by several Indian courts now require that all government departments to sell off items only through transparent e-auctions. And MSTC is usually the company that is trusted by the government to assist in this process. As it is owned and controlled by the government, this brings monopolistic rights to MSTC. For example, in FY22, MSTC was given the exclusive rights to conduct e-auctions of 7,665 liquor shops in 34 districts in Rajasthan on behalf of the state's excise department. Even public sector banks sitting on repossessed assets such as land, buildings, and apartments confiscated from defaulting borrowers need to sell them to recover loans which have become non-performing assets. In FY22, MSTC helped Indian public sector banks sell 6,134 properties for about $650 million. This is a tiny number as of now, but will grow significantly over time as MSTC helps these banks convert their NPAs into cash. Indeed, MSTC has been hired by Indian Bank Association to develop a platform for online auction of assets attached by its members. However, NPAs are not the only thing that needs to be converted into cash. In India, many temples receive enormous quantities of gold and jewelry from devotees as offerings to the gods. These assets too need to be converted into cash by these temples. Temple trusts in South Indian states of Karnataka and Tamil Nadu have hired MSTC to help them in this matter. These are just a few examples to demonstrate the sheer diversity of the kinds of auctions conducted by MSTC. I like the growth mindset of MSTC's management. Indeed, the company is also working towards helping private sector clients sell unwanted but valuable stuff via e-auctions. In the company's annual report for FY22, the company wrote, MSTC is casting more focus on the untapped e-commerce business from private sector, and in this stride, MSTC has signed big-ticket agreements with Reliance Industries, Indus Tower, Tata Power, L&T, Jindal Group, Vedanta, etc., to name a few. Online auctions are a form of e-commerce that takes advantage of the digital platform's capability to breach geographical limitations, furnish real-time data, and minimize transaction costs. This results in huge convenience benefits to both bidders and sellers transacting business on the platform. The platform, of course, becomes more valuable to a seller if it already attracts more buyers. In turn, buyers go where the sellers are, which makes the site still more attractive to the sellers. These network effects are playing out in MSTC. As gross merchandise value, called GMV, has grown, so have the company's revenues. But operating costs have not risen in tandem, just what one would expect from a profitable and growing platform business. As a result, pre-tax margins have soared from 29% in FY18 to 69% in FY23 in the e-commerce vertical. In FY23, MSTC's revenues were just 0.12% of GMVs generated by the company in that year. This tiny percentage on GMV represents a significant entry barrier for new entrants and add to the competitive advantage of MSTC derived from monopolistic rights granted by the government, as well as the network effects which attract a large number of buyers and sellers to its platform. The government of India and its related parties will always have the need to sell off things in a transparent manner. I expect the GMV to soar in the next decade or so. As GMV grows, even a tiny spread of 12 basis points will produce rapidly rising revenues. And thanks to the significant operating leverage in this business, earnings should grow even faster in the e-commerce vertical. One of the best aspects of MSTC that I love about its e-commerce business is that it requires no incremental capital to run and grow. Indeed, surplus cash on the books matches net worth of e-commerce business. This surplus cash can be taken out of the business without affecting its ability to grow. The charm of a wonderful business which can grow without requiring incremental capital has been praised by none other than Warren Buffett in the past. For example, in 94th annual meeting of Berkshire Hathaway, he said that there is a huge difference between the business that grows and requires a lot of capital and the business that grows and doesn't require capital. And generally, financial analysts don't pay adequate weightage to the difference between those two. In fact, it's amazing to see how little attention is paid to that. Believe me, if you're investing, you should pay a lot of attention to that. As mentioned earlier, one key reason why MSTC's growth in the e-commerce platform requires no incremental capital from shareholders is the presence of float. To deter non-serious bidders from ruining the sanctity of the auctions, every bidder has to give a refundable deposit to MSTC before any auction. This deposit is refunded on the completion of the auction, but if a successful bidder fails to pay the final bid price, it is forfeited. As the business has grown over the years, so has the amount of float available to MSTC. While it has temporary possession of this float, MSTC invests it in short-term, high-quality fixed income securities, which adds to the operating profitability of this business. One key part that I want to talk about in the context of float in MSTC. If you look at the financial statements of the company, you will find that the income on the float is recorded as other income. It does not form part of operating income. It does not form part of operating cash flow. But I think this is incorrect because the float income is integral to the operations of the business. In my view, that income should be counted as operating income and should very much form part of operating cash flow. So I have made that adjustment analyzing this business model. Another interesting aspect about MSTC is just how much of the wonderful performance of its e-commerce business was camouflaged by the performance of a poor quality legacy business which produced losses but is now an insignificant piece in the larger picture. Moreover, the causes for the losses have also been fixed and this business is not expected to burn cash going forward. For many decades before the e-auction business was started, MSTC acted as a facilitator for procurement of industrial raw materials like heavy melting scrap, low ash metallurgical coke, HR coils, crude oil, naphtha, coking coal, steam coal, etc. for supply to industrial consumers. This was essentially a trading business in which on orders received from the customers, the company would procure the raw material, hold it as its own inventory and then sell them at a small markup over cost to its customers. Unlike the e-commerce business, this trading operation was hugely capital intensive and not just because of inventories but also because of the receivables thanks to sales on credit. Given large capital requirements in this business, a small markup over cost meant that the returns on capital were pathetically low. On top of this, many of MSTC's privately owned customers defaulted on their obligations to pay the company for material supplied to them. This resulted in huge bad debts for which provisions were made over a 10 years ended on 31st March 2023. Aggregate reduced pre-tax earnings of the company by a staggering 54%. Thankfully, this trading operation has now been fixed. The company no longer supplies materials to its customers until it has in its possession a bank guarantee for 110% of the value of the supply. So there will be no more bad debts. Moreover, this trading operation, which now breaks even, represents just 3% of MSTC's FY23 revenue. While I don't have time to explain the intricacies of accounting which was causing the camouflaging of the earnings of the e-commerce platform, basically the point that I want to make here is that these bad debts of old business which were being written off had no relevance for the future earning potential of the company and they were massively hiding the emergence of a wonderful platform business coming out of the e-commerce vertical. Yet another aspect of MSTC is a 50-50 joint venture with the Mahindra Group called Mahindra MSTC Recycling Private Limited. This company is an authorized registered vehicle scrapping facility for vehicles reaching end of their life. These old vehicles are purchased for depolluting, dismantling and converting the metallic parts in an environmental friendly manner. Since the Mahindra Group is in the business of manufacturing automobiles, this joint venture with MSTC gives it access to steel scrap, which is cheaper than buying newly minted steel. But why is MSTC into this business at all? One key reason is that MSTC owns a platform through which the end-of-life vehicles are sold via e-auctions. In December 2022, the Government of India issued a directive regarding its scrappage policy, a government-funded initiative which seeks to phase out old passenger and commercial vehicles, thereby reducing urban air pollution, increasing passenger and road safety, and stimulating vehicle sales. According to this directive, the Vehicles of all government departments, including state government departments, which are more than 15 years, are required to be scrapped compulsorily. And all the auction of that vehicle prior to scrapping must be done on MSTC's platform. Therefore, MSTC essentially gets monopoly rights on the sale of all government vehicles which are reaching end of life, which is going to become a spectacularly profitable business over a long period of time. At this moment, however, it's a very small component of the whole piece. The company also owns a 100% subsidiary called FSNL, which provides steel mill services such as processing steel mill slag for recovery of iron scrap and other metallics. Interestingly, this business, which is profitable, is up for sale, and the government of India has started the process of divesting it completely. While I don't know when the sale will happen, I do know that the sale proceeds will come to MSTC, and it is likely the company will either distribute part of it or all of it as a special dividend, or invest it in the recycling joint venture, which is profitable but a capital intensive operation. To summarize, MSTC is a wonderful e-commerce and IT consultancy business with a debt-free, cash-rich balance sheet. It owns a poor quality legacy business. That business is now an insignificant part of the company and is also not expected to lose money going forward. More importantly, MSTC has an attractive recycling business which is expected to be profitable and will grow a lot over the next few decades. And it owns another profitable business which could soon be sold, and the money from the sale is likely to be used judiciously. In May 2023, the stock at 300 bucks or so was selling for less than 7 times pre-tax earnings for FY23, implying a pre-tax earnings yield of 15%, which compares favorably with pre-tax AAA bond yields of about 7% a year. Equally important was the fact that the core e-commerce business was growing rapidly. Pre-tax earnings had been growing at an average annual rate of 38% over the last 5 years. And more importantly, it requires no incremental capital investment for growth. In FY23, this exceptional business delivered pre-tax margins of 69%. Dividend payout ratio of the company was more than 40%, and starting dividend yield alone was 5%. And on top of all this, one could also get to own a promising recycling business for nothing. Finally, MSTC stock had no significant institutional ownership and no significant coverage in the investment analyst community. Perhaps the emergence of an attractive platform business, which was camouflaged by the poor operating performance of the legacy business, had a role in the relative lack of interest from the street, apart from the fact that it is a microcap stock. Not only MSTC is a microcap, it is also a tiny company if you compare it with what it could become in the next 10 or 20 years. Consider this: at the current stage, the company earns less than 500 crores in pre-tax earnings. With a platform business model which can grow several times from the current size, and given the operating leverage in the business, I don't think it will surprise me to see the earnings of this company grow over a very long period of time. Regardless of that, you should keep in mind that I am biased because I own the stock and my clients own the stock. So please keep that on the forefront of your mind and do not consider this as a recommendation to buy this stock. In all the three examples that I cited, which are all PSUs, you would have noticed that the re-rating of the stock has happened over a very short period of time and nothing happened for a long time. This reminds me of the parable of the bamboo farmer. A farmer plants and nurtures the bamboo seed with water, fertilizer, and care. For the first year, despite all efforts, there is no visible growth. The farmer continues to water and fertilize the bamboo for the second year, yet there is still no sign of growth above the ground. The same happens in the third and fourth years. Suddenly, the bamboo tree sprouts during the fifth year and can grow up to 90 feet tall in just 6 weeks. Value investing is no different. One gets paid for the waiting with the confidence that if the investment hypothesis is logical, then the markets will over time correct the extreme undervaluation. Obviously, as you can see in these three charts, nothing happened for a long time, and then over a very short period of time, there was a massive re-rating. And I'm not cherry picking here. This is just a pattern that is played out in the overall PSU index. As you can see here, I'm just giving you three representative examples of this change of perception that has happened on the Indian stock markets on PSUs. I reproduce here the slide on the 4 key lessons I had shared with you earlier in this presentation. These 4 lessons are all been applied in the cases that I've talked to you about today. The difference between perception and reality, unwarranted pessimism, being right by focusing on the data and the numbers and the quality of the business and not on who is the person who controls the company, and to have faith in the idea that in the long run the market will be a weighing machine, even though in the short term it might turn out to be a voting machine. So let me now end by giving you some overall thoughts on how I think about value investing. Value investing is about exploiting prejudices of others in the markets, and there are all kinds of prejudices out there, and it's important to have an open-minded approach while doing fundamental analysis, much like the process called prudential algebra as described by Benjamin Franklin. Charlie Munger used to talk about the importance of avoiding heavy ideology because it totally screws up your mind. He was very much in favor of having a balanced view of things. And one space where I see balanced views are not there is today the world of fossil fuels. If you look at what is happening in that space, in both in the world of business and the world of investing, people are running away from coal and natural gas and oil. These have become untouchables. Many countries around the world are getting out of fossil fuels because it's politically incorrect to be in that space. But even more important, if you look at the investment community today, especially in the institutional investment community, this has become an untouchable space, and that is music to my ears. If you want to have a balanced view, then there is one author called Alex Epstein who has written a wonderful book. You should follow him on Twitter, and I'll produce some of his tweets here. And he basically urges you to look at fossil fuels from a balanced perspective, much like Benjamin Franklin would have had you look at that situation. He urges us not to look at a one-sided view of fossil fuels, and to also look at what these fossil fuels have done for civilization. He asks us to look at the contribution that they have provided to the world. And I just end by producing some of his tweets, which came out a while back, which I think are very important to help us understand the need for us to have a more balanced view of the whole thing. Instead of focusing only on the cons of fossil fuels, let us also look at the contribution fossil fuels have and what they are likely to provide. And if you believe in that, and if you believe in what Alex Epstein is saying, and I do for sure, then I think there is an opportunity for investing your money in that space. Clearly, in my view, there is a prejudice against fossil fuels today in the investment community, which is making some of these businesses in that space, which are extraordinarily high quality, selling at ridiculously low valuations. And I think these are unwarranted prejudices, which are waiting to be exploited. Prejudice equals opportunity. Thank you.
Thank you very much, Professor Bakshi. That was a very interesting and insightful talk. We have a few questions which have come in. I don't know if you can see them in the Q&A box at the bottom of the screen. If you'd like to take
I
those.
can.
And then I think the rest, if there are more, then we can also do them on email.
Okay. Chandni Sahil is asked, is IRFC the value buy? I don't want to comment on this, Chandni. I actually don't want to use this as a forum where I'm giving out recommendations. I am only using these examples to illustrate some key ideas, which I have done, I hope. So I would take a pause on that. The next question is from Siddharth Korea, who asks, when do you decide to exit a company such as the ones you described? Again, I think it's important to recognize that selling is very tough. Selling is riddled with psychological biases. One way to deal with those biases is to not think sell, but to think switch. So you have to think of some alternative investment that you think will be significantly better than the one. It could be in terms of quality of the business, it could be in the terms of valuation, it could be both. Usually it should be both. And basically, if you, the moment you make it into a switch decision, it becomes easier. That's one big reason to make that switch. The second is that if you go wrong, of course, the switch will show that too, because something else is far superior to what you have. So it's covered under the switch option. But then there's another reason. If the on a portfolio risk metrics, if that position becomes extraordinarily large, and I don't want to give a number here, it's a very subjective assessment. If it is giving you sleepless night, if the position size has become very large because the stock has gone up and up, it's a good problem to have, right? So take some money off the table. And we've done exactly that in at least one of the examples that I've cited over here. Whether it's the right decision or not, only time will tell, but at least it helps us sleep better at night. So that is the another reason why you would want to sell down a position of the company. The other one is, what's your opinion on the oil and natural gas sector? I already laid that out. I am positive on that space. Not just oil and natural gas, basically fossil fuels. There are other fuels. which also get covered. So you can do your own homework and figure out whether it makes economic sense for you to participate in that space or not. That was the last question by Vijay Zade.
Thank you. I don't think there are any more questions, Professor. I had a very small question myself,
Yeah.
which I'd like to ask you. In your experience, have you seen companies that have in the PSUs that have been hit very badly because of like an overnight government decision that has thrown them off and they've never recovered?
Okay, now this is a very interesting and complex question. The answer is, of course, is yes, it has happened, and therefore, could you get bond in this by investing in this? The answer is absolutely yes. But then here is the thing: if you could get burned here, you could also get burned in privately held companies, also companies in the private sector space. Same thing. There have been multinational companies which have had the best track record over the years, and suddenly they decide to do something to jack up the royalty rates or to set up a 100% subsidiary in India, which essentially ends up hurting the minority shareholders of the listed company in India. So what do you do when that happens? You just change your mind and then you protect yourself against those by having diversification in your portfolio. It's a risk worth taking, in my view, especially when you look at the prices. The most important part of my answer to your question is that the risk is there, but don't just assume that risk is there only in PSUs. Again, that bias comes. It's equally there in the private sector space. So the promoter risk is there in the private sector space also. They can suddenly decide to do related party transactions and take money out, or to put their daughters or sons in who are not very competent on the board and get pay them a lot of money. And there are 50,000 ways of taking money out of the company. And I think we all know about that. So there are risks in that space as well. So answers, but I'll come back to one example that comes to mind. Many years ago, there was a news report that Hindustan Aeronautics Limited has been asked to borrow money to pay salaries, and the stock went down like anything. Now, if you think about what happened subsequently over there, firstly, it's again a monopoly player in the defense industry. If you look at the order book of the company over the years, it has grown and grown, and the earnings have grown, and the valuation has grown. What was happening was that because the government announced that you borrow right now, you're short on cash, we can't give you money, you borrow money to pay the salaries. Okay, if you look at it from a isolate in a silo kind of a situation, it looks like a bad thing. A lot of people sold out of this stock. But if you really think about it for a moment, you realize that can they actually do something that can hurt HAL? Will India get hurt if HAL goes bankrupt? The answer is overwhelmingly yes. Will they ever do this? So maybe they thought that there's a large order book. It's only a temporary borrowing that you have to do right now. There'll be more earnings coming down the road. Exactly how it's played out. We have this propensity to overreact to a certain development that looks like an adverse development, but in hindsight, it turns out to be an opportunity.
Thanks. Thank you very much. I think there's one last question from Saurabh Jain. I think you can see it, Professor. And I think we'll wind up after that.
Okay, what kind of allocation did you have in these three companies, and what was the margin and where their margin of safety? In 2020, we were 40% plus in PSUs. And that number went up because of the expansion of market valuation of these companies. But I didn't have any hesitation on having that kind of allocation because that's where the value was. If you think about it as a value investor, what is my job? My job is to find good businesses at cheap valuation. If they happen to be they're all different industries, by the way. They're not just because they're owned by the same president of India doesn't mean that there's a concentration of risk happening. At least in my mind, that was not the case here. So I had no hesitation in putting 40% of capital in PSUs where there were a whole bunch of them in very different businesses, had very superb markers of quality and really extraordinarily low valuation. So there was an opportunity there. Today, I would do that in other spaces. Today, I wouldn't do that in obviously in this space, but I don't think there should be a problem. You've got to go where the value is. If the value is in a space which is prejudiced against for the wrong reasons, you got to go in that direction. That's the whole idea of having a contrarian mindset, and that lesson that I spoke about, that you're neither right nor wrong because you disagree. There's no point being contrarian just for the sake of it. A lot of pessimism is warranted. So just betting against the crowd recklessly without thinking about it is, I think, quite dumb. You have to do the calculations, you have to do the analysis, you have to do a thoughtful, careful analysis of the business model and think about the prospects of the future and then make the call about whether you want to participate or not.
Thank you very much, Professor Bakshi. I think you did a great job in maybe changing some of the mindsets of some of the people who participated today, or at least giving them a way to think about how to go about thinking against these prejudices. Again, thank you very much for a very nice talk. And on behalf of the LSE Alumni Association of Mumbai and Western India, as well as the LSE Research and Education Foundation India. Thank you.
Thank you. Thank you for having me. Thank you. Thanks everyone. Thank you.